Hello and welcome, everybody. Thank you for joining us. My name is David Vandeveer. I'm the Executive Director of the Passero Center for Financial Markets and Policy. Here at the Passero Center at Georgetown University's McDonough School of Business in Washington, D.C., we provide responsible expert insights relating to global finance. The Passero Center's work addresses how global finance can provide impactful and innovative solutions to benefit society broadly. We pride ourselves on having academic-based and nonpartisan research and discussions and convenings such as this. We welcome you to this, our third of our segment, talking about the banking sector and the recent developments there. We're focusing on these as explainers to kind of give just a general overview of what's happening. So with that, I'm joined by Manmohan Kumar and Sandeep Dahiya, both of whom have been stars in our two previous episodes, and now we're bringing them together to discuss First Republic Bank's failure over the weekend and kind of looking forward. I think we're going to be talking about focusing on, are the regional banks strong and stable? So with that, just bringing us up to speed, we had the failure of Silicon Valley Bank, we had Signature Bank, and we had Credit Suisse. Some time has passed and it seemed like the crisis was averted, but recently First Republic failed, the FDIC stepped in, and it was announced that JP Morgan Chase will be buying First Republic. So I guess I want to start off with Manmohan and ask you, what happened with First Republic Bank?
So, David, First Republic Bank essentially was hemorrhaging deposits. During the first quarter, it lost over $100 billion in deposits. There was a very real concern that given the sharp decline in the values of its assets, that actually it wasn't only a liquidity issue, it's also a solvency issue. And so then, as you said, the bank was collapsing. The regulator seized control of it and sold it to JP Morgan on Monday, almost 2 months rather, into the banking crisis, which began, as you noted, in March. We had the Signature Bank, the Silicon Valley Bank, and the crisis and the collapse of Credit Suisse. First Republic is the second largest US bank by assets to collapse after Washington Mutual, which had failed during the financial crisis in 2008, and which was also acquired by JP Morgan. The First Republic shareholders and debt holders will be wiped out. That's a typical occurrence. What had happened was that late last week, when it had become evident that First Republic could not survive, FDIC had reached out to other financial institutions, including JP Morgan Chase, PNC Financial Services, and Bank of America, seeking bids for First Republic. As you also noted, it was actually yesterday, very early, before the markets opened Monday morning, that JP Morgan's bid was accepted and the bank was sold to, First Republic was sold to JP Morgan.
Thank you, Manmohan. Really appreciate that background. Sandeep, I think it'd be helpful to the viewers to get a sense of, okay, so what happens? How does the FDIC operate? These actions always seem to happen on a Friday night, and then announcements are made by Monday or morning. That's obviously for market purposes, but can you just give us a little bit of a view behind the scenes in, what happens here? What does the FDIC do here in these instances?
So the timeline you laid out, David, is the preferred timeline of FDIC. That's what they would like to do. And the outcome we had with First Republic is also the outcome that is the preferred outcome that FDIC likes to have. This is what is called the purchase and assumption method. Ideally, over the weekend, you would get a healthy bank to buy all the assets, buy all the liabilities, and then on Monday, You change the name on the front, and the bank reopens. This is the ideal scenario, and most of the FDIC takeovers of failed banks go through this process. You could also have a situation where FDIC doesn't have any buyer. With SVB, that was a problem. I think they tried over the weekend, didn't receive any bids. So at that point, FDIC literally is running the bank. It's keeping the bank on hold till it can find a buyer. Worst comes to worst, you can also just close down the bank, and then FDIC make sure that all the deposits are paid, for the insured deposits are paid. So the purchase and assumption method, what requires this closure so that, over the weekend they can assess the bids by various banks, see which one is the most useful one. Legally, they are supposed to minimize the loss to the taxpayers. The bid that provides the least amount that FDIC has to pay should be the one they should consider. Of course, they could have, some wiggle room around it. Not every bid is watertight. There could be other things that are built in. So that is pretty much, what a textbook FDIC receivership of a failed bank should go like, and that's what happened in this case. And if the news stories are to be believed, there were multiple bids for First Republic, unlike for Silicon Valley Bank, where there were no bids.
Thank you, Sandeep. That's a helpful explainer. It does also remind me, and I think it's been in some of the news stories, but not all, the reminder that, a lot of large major financial institutions, back when the crisis happened with Silicon Valley Bank and Signature Bank, they put in $30 billion to shore up First Republic, right? And yet still, we still had kind of the takeover situation that you just described over the weekend. So I guess the question really is, do you think that we're going to be seeing more failures? Is this an issue of present credit concerns? Is this systemic? Is it persistent? What do you think, Sandeep?
So first thing that I want to take off the table right away is the credit. There was nothing in any of the banks that had anything to do with credit. This is very different from 2008, where you really had a huge amounts of mortgage assets that were just underwater, that the people weren't paying them. There was a lot of subprime lending. Silicon Valley Bank is a textbook example. I mean, bulk of their assets were actual US Treasury securities. Their problem was they were worth far less than what they bought them for. And, Manmohan can shed some light on interest rate and spikes we have had, but it has absolutely nothing to do with credit. First Republic did not have US securities. They had mortgages, but these were not bad mortgages. These are mortgages to Mr. Zuckerberg and other, tech billionaires. They are not defaulting on their mortgages. Problem is, these mortgages were made when the mortgage rates were very, very low, and you cannot get those mortgages and they're worthless. So I don't think credit is an issue. In terms of, is it the last bank failure we have seen? I'll be a millionaire if I knew the answer to that. But I think regulators are very aware and concerned about the contagion risk. So I would expect if some other bank was to appear in the headlines, I think the regulators are going to move faster than they have with the banks we have seen so far in trying to contain that contagion.
Thank you, Sandeep. Thank you for clarifying that. I think that's an important thing for the viewers to know. And, Manmohan, Sandeep touched on this, but I want to scratch the surface a little more in this one too. What is the underlying cause here? Is it interest rates? Is it the regulatory system? Is it the individual business models, or all of the above? What are we looking at here?
I think, David, I think it would be fair to say it's all of the above, right? With, perhaps particular emphasis on the business model and on the interest rates. What happened, in terms of, the Fed's actions, increasing interest rates to deal with inflation, which had become, too high. And then, the interest rates had to be increased very significantly over a very short period of time, right? It's the increase compressed and the speed with which it was done. But, with regard to the business model, I mean, it is actually fascinating that, the First Republic, its services, as Muhammad Al-Arian puts it, is legendary. It's it's a large bank, okay, but the service was, you had a very personal feel, and it dealt with its customers in a way which is perhaps not that common, and the basic approach was to get deposits, as many deposits, so the motto of First Republic was deposits, deposits, deposits. Right, and actually the management and the employees were the compensation was linked to how many deposits they could pull in, and those were deposits from well-heeled customers. And then on the other side, in terms of loans and investments and so on, they were also made, so Sandeep referred to Mark Zuckerberg, borrowing in the early 2010s, a mortgage from First Republic. So they had well-heeled depositors and well-heeled customers in terms of, the mortgages they had. Now that model worked well. You're providing very good service and you're pulling in deposits and you are investing them. But when you have this very significant change in the environment, right, in terms of the interest rate environment and more broadly, then that model begins to become undone. So what you had was a situation where First Republic had to pay more to attract deposits, right? Because the interest rates were going up, and the value of its assets, which, as Sandeep emphasized, it wasn't a credit issue. It was simply that you had, the interest rates, sharp increase in interest rates, mortgages, fixed rate mortgages, which were given at sort of 1% or 2% are now, worth far less. And the securities also, which it had, First Republic had acquired. And then, the flip side of having these well-heeled customers, depositors, was that a significant proportion of the deposits were above the $250,000 limit of the FDIC. So they actually, the First Republic began to see a significant outflow in February. And there's a lot of talk of the role of social media, and actually we talked about that in the context of Credit Suisse collapse, right? These are well-heeled depositors. They see that there is going to be problems in terms of the bank's model, business model. They yank money out very, very fast, and therefore, during the first quarter, as I mentioned earlier, over $100 billion was taken out. Now, in terms of so the business model in this environment of attracting these depositors, making these loans, and so on, that was and growing very fast. The bank's assets were growing at a phenomenal rate, right? Now, that in an environment of increasing interest rates doesn't work. And then the regulators also, and this is something which, there were 3 reports released on Friday, by the Federal Reserve, by the FDIC, by the General Accounting Office. Essentially, the message is similar, although they're looking at the problems which were at the Silicon Valley Bank and Signature Bank, that the regulators did not appreciate, or where they did appreciate, the banks did not act fast enough given the changed circumstances. And so, regulators in many cases, actually in several cases, did emphasize the vulnerabilities. There's no question about that, but more could have been done by them. And for sure, a lot more could have been done by the banks and First Republic itself. So a combination of all 3: business model no longer works, macro environment has changed dramatically in a very short period of time, and the regulation could have been, the process could have been different, and the banks could have acted more, First Republic could have acted more much earlier.
Great. Thank you very much for that. So Sandeep, Manmohan just mentioned the Federal Reserve report and all the reports that came out, the DFS and all the other reports that came out on Friday. And the headline, I think, the takeaway that people read into it was that, the regulators felt that they needed to tighten the regulatory system, especially for the regional banks. Is this really becoming a regional bank issue? How do you see these reports?
So everyone would like to blame their predecessors, right? So, so regulators are no different than us. There is, Michael Barr's report says a lot of things that make total sense, and they are, in some cases, they are self-evident. Yeah, Silicon Valley Bank should have been smarter about its risk management. The management should have been more aware of it. The board should have held them accountable. The regulators should have been more forthright. But it's also you to appreciate that we are fighting a war with a hindsight. With perfect hindsight, it's very easy to see what went wrong, what's there. What I would like to know is, can someone tell me in 10 years what is it the crisis that is going to happen? And like 10 years later, let's go and see if that happened or not. So just like, they say the generals always fight the last war. Regulators fight the last crisis. Last crisis was a lot about capitalization. It was a lot about credit risk. It was a lot about retail loans. And guess what? None of those were present in Silicon Valley Bank, Signature Bank, or in First Republic. They had excellent credit quality right up till they were taken down. They had capitalization ratios of 14, 15%. Nobody like now we all say, oh, interest rate risk, asset liability management, this is banking 101, and it is. But if I am willing to bet, if you were to go back 2 years and do a Google search on interest rate risk, you'll find nothing. It's been 40 years since interest rates have actually gone up. The last time was Reagan presidency in early 1980s. So we all got caught out. Yeah, it's. Do I have anything to push back on the suggestions? No, I think these are good suggestions, and I think it's the Barr report talks about how regulation needs to be better, faster, more focused. But what I would have liked to know is how many auditors were there in Silicon Valley Bank. At one popular press report seemed to suggest there were 34 examinations going on. And my view of regulators is OCC is inside every bank almost all the time. So yes, you have to keep in mind, regulation is not free. Regulation costs, its compliance is costly, regulators have to hire staff that is good at this stuff. And by all means, I'm not saying that we don't need regulation. We should have good regulation, targeted regulation, well-executed regulation. But the standard approach of, oh, there's a crisis, we need to do more regulation, I think that's where I fear that we are going towards, which needs to be more measured, I think.
Great. Thank you, Sandeep. Manmohan, what do you see coming out of these reports, and I guess the financial and macro implications? Do you see, the question that I keep wondering is are we out of the woods? Is there, what's the contagion is the symbol that's used a lot, and so using the fire symbolism, are we talking about embers here? Has the water put them out? Is there just smoke rising? What do you kind of, not to ask you to kind of tell us the future, but I do wonder, what do you see where we are right now?
So David, I think it would be fair to say that we are probably out of this set of woods. Okay, I think the likelihood that there are going to be other small or medium-sized banks coming under pressure, like immediately, in the next few weeks, or we're not going to be doing another program in the next 2 months. I think that likelihood is low. Everybody's on guard, regulators on guard, banks are on guard, and this has now been going on for 2 months. And the largest banks are on much sounder footing, as we said earlier also. But beyond that, I don't know if one can say this is it. We are not going to have any further pressures, volatility, or even some banks going under. I mean, it's not. We are not out of the forest. We are out of one set of woods, and the reasons for those are there's several. Right. I mean, I think, we talked several times about the interest rates. And I do want to emphasize that it's both the magnitude and the speed. Okay. And, you are seeing, you have seen, across a broad range of small and medium-sized banks, pressures emanating from that. Then you have, you look at the portfolios, the asset portfolio of small and medium-sized banks. On average, a quarter of their assets are in real estate, and commercial real estate especially. And that is coming under a lot of pressure, in part also because of the increase in interest rate, but also slowing down in activity. The Fed, is raising rates, to bring inflation down, and one of the channels it works through is by slowing down activity. And so I think that's going to have, that could have actually pretty substantial impact. I mean, I was looking at some of the numbers, and they are fairly concerning. That more than $1 trillion in commercial real estate loans will come due before the end of 2025. And then, as banks now aware of the pressures or aware of the risks, they tighten their underwriting. To refinance these, real estate loans is going to be an issue. And as the credit, Moody's actually downgraded 11 regional banks in April, specifically citing commercial real estate exposure. So I think we, as rates remain high, so we're going to have the Fed, tomorrow, perhaps another 25 basis points. And the broad consensus is that after that, it will be on hold. But, it's still, you've raised rates very fast, very significantly over a short period of time, or you've had to raise them. And so I think, we would have to think in terms of the implications of that, not just for liquidity, but also for solvency. And I think that's something to keep in mind. And I want to, I think, bring to the table a few points which Mohammad Al-Erian mentioned, which I thought were very, very pertinent, coming out of this crisis. So, first thing which he says is that look, where he calls it, I think is beautifully put, collateral damage and unintended consequences. Okay, so you've got JP Morgan, which is already the largest bank in the United States, becoming even bigger. So in 2008, you had this notion of systemic banks too big to fail. Well, you make them even bigger. Well, there's something, a little bit strange there. Then there is a question of, Mohammed has emphasized, the implications of this and the earlier failures for the, de facto insurance system in place. And then, I mentioned, Mohammed has also talked about the provision of credit. This is going to, broadly, not just to real estate. No, this is going to be constrained, and you're going to have already, activity slowing down, and that could be exacerbated. The slowdown, the credit is not becoming available. So I think there are a broader set of issues in addition to the contagion effect purely, resulting from what has transpired.
That's a very good point, and I think we're going to have to leave it there. But just looking ahead a little bit, where we are right now and a little bit in the future, there's clearly it looks like some more volatility to come. As we've all talked about, there, you raise the commercial real estate market. We're in the month of May, and the debt limit issue is something that seemingly could cause. It's already causing some disturbance in the futures and the options and state and local markets, but it's got the potential to be a very volatile month or a couple of months. And so we're going to be keeping an eye on this and hopefully continue doing more of these video updates as explainers. So thank you very much from the Passero Center for Financial Markets and Policy. We appreciate your time and we'll look for more segments to come.
Thank you for having us.
Thank you for having us.